A FICO score is a number from 300 to 850 that estimates how likely you are to repay borrowed money. Lenders use it as a shortcut, and roughly 90% of top lenders rely on FICO scores when they make credit decisions. The scale is split into bands. Poor is 300 to 579, fair is 580 to 669, good is 670 to 739, very good is 740 to 799, and exceptional is 800 to 850. Your FICO score comes from 5 categories, each with its own weight. Payment history is the largest at 35%, amounts owed is second at 30%, length of credit history is 15%, and credit mix and new credit are 10% each. These published weights describe the general population, and they tell you where your effort tends to pay off most. Payment history and amounts owed together make up 65% of the score. That means whether you pay on time and how much of your available credit you use are what actually move the needle. Everything else matters, but those 2 factors dominate. Amounts owed is largely about credit utilization, the share of your available revolving credit you're using. The CFEP notes that experts advise keeping utilization at or below 30% of your total limit, and lower is better. Utilization has no memory and is recalculated from your most recently reported balances, so paying balances down can move your score within 1 or 2 statement cycles. A common myth says you must carry a balance and pay interest to build credit. That's false. Paying your statement in full keeps utilization low and still records positive payment history. Carrying a balance only costs you interest. It does not improve your score. Checking your own score or report is a soft inquiry and has 0 impact on your score. Applying for credit creates a hard inquiry, which typically lowers a FICO score by about 5 to 10 points, and for most people, often less than 5. Hard inquiries stay on your report up to 2 years, but FICO only counts them for the last 12 months. Shopping for a mortgage, auto loan, or student loan does not punish you for every application. Newer FICO models group same-type loan inquiries within a 45-day window into a single inquiry, and older models use 14 days. So comparing lenders in a tight window counts as just 1 inquiry. Your FICO score does not include income, employment, age, or your savings and checking balances. By law, it also cannot include race, color, religion, national origin, sex, or marital status. A high earner can have a poor score, and a low earner can have an excellent one because the score measures borrowing behavior, not wealth. Accurate negative information generally stays on your report for up to 7 years, including most late payments, charge-offs, and most collections. Per the CFEFPB, a bankruptcy can remain up to 10 years from the date the order was entered for both Chapter 7 and Chapter 13, though completed Chapter 13 filings are often removed near 7 years in practice. No one can legally remove accurate negative information early, but its impact fades as it ages. The 3 nationwide bureaus voluntarily removed paid medical collections under $500, and those less than 1 year old. But the broader 2025 CFPB rule that would have stripped all medical debt from lending reports was vacated by a federal court in July 2025 and is not in effect. Larger unpaid medical collections over $500 can still appear. You can pull a free report from each of the 3 bureaus once per week, permanently, at annualcreditreport.com, and you can dispute genuine errors yourself for free. The fastest legitimate moves are lowering utilization and never missing a payment, since those drive most of the score. For context, FICO 8 is the most widely used base version today. Mortgages often still use older models like FICO 2, 4, and 5. And FICO 10T adoption is accelerating, with more than 40 lenders in its adopter program as of February 2026.